Right, next we're going to look at the cash flow statement question, which was question 6. Again, 70 marks, so you have 42 minutes. Endure Limited. Year end is 2012 and 2013, February each year. Okay, Endure Limited has a registered authorized share capital of 1 million shares. Alright, now we're asked to prepare the reconciliation between the profit before tax and the cash generated by operations. That's one of the notes of the cash flow that you should know off by heart. So here's the format of the cash flow statement, and this you should know off by heart. Cash generated from operations. So this is the note that they're asking us to complete, and here is the detail of that note. You will see here that there is, you start with the profit before tax, then you have to adjust in respect of non-cash flow items, which could be depreciation, is an example of a non-cash flow item. You also adjust for items disclosed separately. Interest expense, the reason we add that back, you see both of these are positives. We're adding them back to the profit before tax because then depreciation is a non-cash flow item, alright? So it shouldn't be there's already a minus depreciation included in the profit before tax, so to reverse that effect of the non-cash flow item, we add it back, right? Interest expense, there's already a minus for the interest expense included in the net profit before tax. So because this interest is disclosed separately, have a look here, we've got interest which is on a separate line item. So we can't have it in year and in year. Okay, so we reverse it here. So that's, even though these two are expenses, we're adding it back because it's a non-cash flow item, and we're adding it back because it's disclosed separately. An example of another item that might be disclosed separately is bad debts. Alright, not disclosed separately, but is a non-cash flow item. Bad debts is a non-cash flow item. Same as provision for bad debts, adjustment, non-cash flow item that will possibly be in net profit before tax. Profit or loss on the sale of an asset is again disclosed separately as part of my proceeds from the sale of fixed asset. Hence the reason that we add that back. Okay, so those are some examples of items that we add back. Okay, then these notes, dividends paid, tax paid, and interest paid. If you're not asked the notes, you can do the calculation using the T account as well. And that's what we're going to do now in this next example. Remember, operating activities, or those activities that you need to run the business. Investing is when you're investing either in fixed assets or in financial assets. Financing is when you're getting financing, either from shares or from loans. And with each one, there's an inflow and an outflow. Okay, so make sure you know this format off by heart. The way you're getting to the cash flow statement is by using your other two statements as a base. You're going to use your income statement and you're going to use your balance sheet. Right, so we're asked to do the reconciliation note, 21 marks, and we're asked to do the whole cash flow statement. Then we've got a number of calculations here with some ratios, asset test ratio, earnings per share, and stock holding period. So we're going to go for these two first because they're kind of related, and then we'll do the rest of the cash flow statements. So let's look at our answer book and see what they've given us. They've given us the basic outline for the reconciliation, really only the heading, and in the cash flow statement they've given us the three headings: operating, investing, and financing activities, and they've already been so generous enough to give us the financing activities: proceeds from share capital, the money we got from the loan that we took out, and a decrease in the short-term loan, which would have been a repayment of the loan. Yes, so we need to fill in we can start off by filling in our overall change in cash and cash equivalents. So where do we get this information? From the balance sheet, yes, exactly. So let's see. information here. They've got information about fixed assets. They've got information here about dividends paid and declared. An extract from the post-closing trial balance, we may need that. Here's an extract from the balance sheet. And here's our cash and cash equivalents. Right, so interesting enough that the cash flow statement is actually a movement statement. And if you took the movement on all of these line items and you add them together, you will see that they add up to the movement on the cash and cash equivalents. Same, you take all of these movements as well. That's really what it is. As long as you take all the movements and you remove any non-cash movements, you're going to get the movement on the cash and cash equivalents. Right. In fact, just by taking the movements on these, because you're already taking into account the movement on accrued accounts, trade and other receivables and payables, you will already take out non-cash items naturally. But you don't need to know that. That's just for interest's sake. Right, so let's do the movement on the cash and cash equivalents. We start off 2012. Make sure you're using the correct year. Please check your headings. Just because it's on the right hand side here doesn't mean the latest year is always on this side. So check your headings carefully. 571,730. That is the cash and cash equivalents at the beginning of the year. 730. At the end of the year, we've got 766,760. And what happened here? Did we get more cash or less cash during the year? Cash actually increased. It went from 570 to 760. So the difference there is our increase of 195,030. And you can show your calculation. 766,760 minus 571,730. Happiness. You were not asked to do this note, so that would be sufficient. Okay, let's start with we're going to work our way down the cash flow statement. We can fill in the format of the cash flow statement as a start. That will help us. Always a good idea when you asked, sorry about that, when you asked any of the financial statements to fill in the format first up. So we've got cash generated from operations. And where we're going to get that from? That we're going to get from our note. Right, and if we continue then, at the bottom here, then, right, cash generated from operations. Then what else do we have under operating activities?
Interest paid.
Interest paid, yes. Dividends paid. And that's the last one. Tax paid. And here you write as fast as you can because you don't want to waste any time. Then we go to investing activities. What do we generally have as investing activities? We've got purchase of fixed assets. All right. But now we can also sell fixed assets. So that would be this one would be the outflow. So what's the inflow for this? It would be proceeds. They actually didn't give us enough lines here. But nevertheless, proceeds from sale of fixed assets. Then we can also invest in financial assets. All right, if we take money and put them into an investment, that's going to be an outflow. And then we can also have that investment mature. So we actually don't know which one we're going to have, and they actually should have given us more lines here. But nevertheless, I will just cheat a little bit here and tell you that we're going to say increase in investments. So that is where we put more money into an investment, and that's going to be an outflow. But you would have put down both normally. Right, then financing activities, they've already done that for us. There was just an issue. We could have also had a buyback, but there was no buyback, it seems. Remember, then you take the buyback amount. To calculate that, you need the buyback price multiplied by the number of shares that you bought back if the buyback amount was not given. But in this case, it wasn't even asked. Increase in long-term loan, okay, that you'll get from your additional information or your loan statement. Decrease in short-term loan, again, from your loan statement or your additional information. Right, but that was given in this case. Now we can start cash generated from operations. That's going to be note 1. And if we start with our net profit before tax. Alright, that's our reconciliation. We start with net profit before tax. And net profit before tax includes a whole lot of items. Alright, it generally includes, if you look at your income statement, let me quickly show you. You go to your financial statements module, you will see that the income statement includes depreciation, it includes interest expense, and before tax it doesn't include income tax yet. Alright, because we start with this figure, net profit before tax, and it already includes all of these other figures. Now some of them are non-cash items, for example, depreciation. Okay, some of them are disclosed separately, like interest expense. Okay, so we're going to have to take them out. What about, let's do that first. Let's do that first. Okay, so let's take out our depreciation. We're going to add back depreciation, and we're going to add back interest expense. Why do we add back depreciation? Because it is a non-cash flow item. Why do we add back interest expense?
It's a cash flow.
No, because it is separately disclosed. We've got a separate line item, so we don't want to have it in our net profit twice. Okay, there we go. Those are those two that we're going to add back. Then we're also going to add back any other non-cash flow items or any other items that is separately disclosed. So let's leave a few lines for those. And then after that, we're going to have to record the change, or once we've added back our, we actually need a heading here. It says add back non-cash flow items. And we need to show depreciation. And if there's any other non-cash flow items, we can also include them there. Non-cash flow items or separately disclosed items. Okay, you don't have to write this actually. I'm just showing you that for interest sake. Then we're going to have your interest expense. And let's just leave a little bit of space if there is one or two other items. Once we've got our net profit before tax and we add these figures back, we're then going to arrive at our operating profit. Sorry?
Operating profits before change in working capital.
Yes, before the change in working capital, and you can write the rest there, and then we're going to have the change in our working capital. Now what is this all about? Okay, this is all about working capital is my debtors, my creditors, and my trading stock. Right, so if my trading stock increases, does that mean I gave out money or did I receive money? So why would my trading stock increase? It would increase if I buy more trading stock. So that would be an outflow. Increase in trading stock is going to be an outflow. Then we've got our debtors. Okay? What would happen if my debtors control increases? It's easier to think of debtors on that decrease side. Why would my debtors decrease? If my debtors come and they pay me money, then they're going to decrease. So the decrease is going to be an inflow and the increase is going to be an outflow. For all your assets an increase is an outflow, and for all your liabilities, a decrease is going to be an outflow. Okay, but it all makes logical sense. Right, then lastly, increase or decrease in creditors. If my creditors decrease, what does that mean? Did I have an inflow or an outflow?
Inflow.
Creditors decrease. I owed 100 Rand last year. Now I owe 0 Rand. What happened to my creditors? It went down because I paid. So is that an inflow or an outflow?
Outflow.
So a decrease will be an?
Outflow.
Okay. So your two assets will be the same, trading stock and debtors. Both of them, if they increase, will be an outflow. Creditors, which is a liability, if they decrease, that's going to be an outflow. Then lastly, you're going to add this figure, and well, you're going to total all of these three together. Add them all up together. You're going to get a total here. You're going to add that to your operating profit before changes, and you will have your cash generated from operations. Happy now? Alright, so our net profit before tax, let's see if we can find that in our information. Is that given anywhere? Here we go. Extract from the income statement. It shows net profit before taxation, not after, 171,820. So that's our starting point. 171,820. Just by knowing the format, it guides us as to how we should answer this question. Right. Now we get to adding back our non-cash flow items. So let's look at depreciation. See if we can find that. We go to our income statement because we think we would find it there. And it does say something here. Sundry net income and expenses, including depreciation and profit on sale of assets. So we know that we also had a profit on the sale of an asset. Okay, so let's fill that in quickly. So we're also going to have a profit on sale of asset that we're going to have to reverse. Okay. So depreciation we're going to add back, so that will be a positive. Interest expense we'll add back, that's going to be a positive. Profit and sale of asset, if we reverse that, how do we reverse that? We have to reverse that with a negative. Okay, these two are already negatives in my net profit before tax. So if I reverse them, it needs to be a positive. Profit on sale of asset, to reverse that, needs to be a negative. Okay, let's go to our information. Now, that's it. That's where it ends. Now we need to find some information about depreciation and this profit on sale. So let's see if we can find that. We don't see anything here. Trade and other receivables, trade and other payables. Here's my fixed assets. We know it went from 565 to 450. Oh, sorry, not that one. Went from 770, or the other way around, 586 to 770. Still doesn't give us enough. Here we go. Here's some information. And let's see if there's anything else. Yes, fixed assets. Point number 1, point 1, and also point number 3. So that's going to give us the information that we need for our depreciation. So let's read. Point number 1. Equipment with a carrying value of 40,000 Rand was sold. Alright, that makes sense because we saw the profit on the sale, right? On 30 May 2012. So my financial year, how does it run?
From 30 May.
It runs from? When does it end?
28 February.
It ends on February each year. So it's going to end here 28 February 2013. And it would have started in 1 March 2012. So March, April, May. March, April, May. This would be 30 May. Alright. and it was sold at a profit of 25,000 Rand. It had a carrying value of 40,000 Rand. Right, the equipment was purchased 24 months ago, and depreciation is written off at 10% per annum on the cost price. The 40,000 thus represents the carrying value after 24 months. Well, that's a mouthful, eh? Let's deal with that step by step. Now again, you open yourself a little calculation. So we know we've got equipment with a carrying value, and it often helps just to start putting down the information. Start putting down what you know. The carrying value is 40,000 Rand. What else do we know? So that we know. It was sold at a profit of 25,000 Rand. Profit on sale is 25,000 Rand. So how much did we sell this asset for? Question is, what is the selling price or the proceeds? How much did we actually sell it for? See if you can work that out. Help you? How do we calculate this figure? Profit on sale of an asset. It is, that figure there is equal to the proceeds, what we get, minus what we give up, right? Any sale. If you buy a Coke for 8 Rand and you sell it for 10 Rand, right? You're giving up 8 Rand, that Coke is worth 8 Rand, but you're getting 10 Rand. That's the proceeds minus what you're giving up. The giving up value for a fixed asset is the carrying value. Okay, because it depreciates every year. That's why we need to use the carrying value, not the original purchase price. So we're going to give up the carrying value or the book value. So that is proceeds we don't know. Profit on sale we know is 25,000. It's equal to my proceeds minus my carrying value of 40,000. Right, so if I want proceeds by itself, I simply add 40,000 on both sides, and I've got 25 plus 40 equals my proceeds. And therefore it's going to be 65. Do you understand the logic? You need to know the logic, otherwise if they give the figures to you a little differently, you don't know how to calculate that. Profit or loss is the proceeds, what you get, minus what you give up, the carrying value. Alright, so that's the proceeds. Where are we going to fill this in?
The depreciation.
Alright, we've calculated the proceeds, which is a cash flow item. Alright, we're trying to looking for the depreciation information, but we've just found another cash flow item, which is the proceeds on the sale. Alright, so we can call this calculation A. Alright, which is 65,000 Rand. So we're going to fill this in the cash flow statement where? Is this an operating activity, investing activity, or a financing activity? There it is. Proceeds on the sale of fixed assets. That's why you need to know your format, so that when you see that, you know exactly where it's going. This is going to go here. 65,000 Rand, calculation A. And is it an inflow or an outflow? It's an inflow. Right. Now that we know that, we also calculated here that the profit, or we know that the profit on the sale of the asset is 25,000 Rand. Now, this profit on the sale of the asset is already included in this net profit before tax. But we've now also included that in here. 25,000 is also in here. So we can't have it in both places. So because it's separately disclosed, alright, the profit on the sale of the asset is actually considered to be a non-cash flow item, because the cash flow item is the proceeds. So we have to subtract it here Otherwise, we're going to account for it twice. Happy with that? Good. Okay, so while we're looking for the depreciation, we found the profit on the sale of the asset, which is good. So now we know we've dealt with this 25,000 and that 40. Now we read further. The equipment was purchased 24 months ago and depreciation is written off at 10% per annum on the cost price. So if it says the cost price, we know that's the straight line method of depreciation, which means depreciation is calculated as cost multiplied by, in this case we have a rate, a standard depreciation rate. So we don't use the carrying amount. Right, so that's how we're going to calculate our depreciation. Or alternatively, if we're given the useful life, we'll say the cost divided by the useful life. Right? This is opposed to the reducing balance method, where we take the carrying amount and we multiply that by the rate. Okay, so here we use the cost price because it says it's calculated on the cost price. If it was on the carrying amount, or if they said reducing balance method or any of that, then it would be the carrying amount times the rate. There's only two depreciation methods for your curriculum, and that's the straight line method, which is cost times the rate, or the reducing balance method, which is carrying amount times the rate. Okay, so we know that's how we're going to calculate our depreciation. They say then the 40,000 thus represents the carrying value after 24 months. Let's read a little bit further. Factory buildings were purchased during the year. So this is another cash outflow that we need to account for. Okay, so we need to make sure that we account for that. So we still haven't found enough information for the depreciation, but let's just take this information into account. Let's just read a little bit further before we do that. Point number 3. This point number 2 deals with dividends and with shares. So let's skip that for now. We want to first tackle this depreciation issue and anything related to fixed assets. The following is that we know we need to account for this outflow on the factory buildings, and we know we still have to add back our depreciation here. So we need to add back our depreciation here, and we need to show the purchase of the fixed assets there. Okay, we've already accounted for the proceeds, but we still need to account for the fact that we've purchased fixed assets, specifically factory buildings. So let's see. Now we've got some more info. Post-closing trial balance, in other words, all the closing entries have been done, and this is what we have. Equipment, we don't know what the closing balance is, probably because we sold that piece of equipment. Alright, so we don't know what that is. Land and buildings, here we know 705 at the end of 2013 and 470 at the end of 2012. So what do we know here? Yes, and they told us factory buildings were purchased. So that makes 100% sense. Even if they didn't tell us, we could have assumed that this movement was because of a cash outflow. So the movement here, it's an increase. That's going to be my outflow. 705,000 minus 470,000. And that's going to give me 235,000 Rand. Is that an inflow or an outflow? Yes, it's an outflow. So we put that in brackets. Right, so now we've dealt with the land and buildings. Okay. And we've dealt with the 1.2 and this outflow, so that's done. We still haven't figured out our depreciation. Equipment, we know that that was the opening cost, and we know that this was the opening accumulated depreciation. Factory, land and buildings is not depreciated. The only thing that is depreciated here is our equipment, which is a good thing because we only have information related to equipment. So the equipment was purchased 24 months ago. So let's have a look. Our balance sheet says the following. It says that our fixed assets went from 586 to 770. Let's go back to point number 1. This 40,000 Rand balance is after 24 months. It's after 2 years have passed. How much depreciation is written off in each year? 10%. Okay, so that's our clue. Let's go to our calculation here. Let's draw a line there. Calculation B. This is now trying to calculate our depreciation. We know the only asset that we have with depreciation on is the equipment. We're given the depreciation rate. We also know that it's depreciation on cost, 10% per annum on the cost price. We have the cost price here, 145,670, right? That's the opening cost. So we've got the cost price. So we know depreciation is calculated at cost times 10%. We know the 40,000 Rand is the carrying value after 2 years. How much depreciation per year? 10%. So after 2 years we would have already depreciated. 2 times 10% is 20%. So how much does this carrying value represent of the original cost? Let me help you. The original cost price would have been a certain amount. Then we had the depreciation for 2 years, and that is 20%. The original cost is 100%, and we know the carrying value is going to then represent 80%, and we know this value is 40,000 Rand. Just by putting down the information that we have, we can find the answer here. So this is the ratio that we know that the cost, the depreciation, and the carrying value is going to be in. This depreciation would be the accumulated depreciation, because it is for more than just the current year. Alright, so we've got 40,000 Rand. Right, that's what we have. I'm going to take what we have, multiply by what we need over what we have, and see if you can calculate what the accumulated depreciation is. Sorry, not the accumulated depreciation. Calculate we're trying to find the cost. We want to find out the cost for this specific asset that was sold, because once we know what this cost is, we can compare that to this cost of all the computer equipment, because we know this represents the equipment that was sold and it represents the other equipment. Okay, so if we can find the cost price of the sold equipment, we can figure out what's the cost price of the other equipment. So what's the cost price here? It's going to be 40,000 Rand times what we need. We need 100, we have the 80 times 100 over 80. That's going to give me 50,000 Rand. Okay, so this half times what you need over what you have always works if you've given a specific ratio and you've got some actual information. You can always find the missing figure. Right, so that's 50,000 Rand. That's the cost price of equipment sold. Important that you know what you calculated. And that is calculation E. Alright. Now that we know the cost price of the equipment sold, let's add another page here. We know the total cost price doesn't change unless we buy or sell something. Total cost price is 146,750. Where did I get that? That was 145,670, sorry. 145. 145 2,670. The sold equipment cost price is 50,000 Rand. So the depreciation, the other equipment cost price is going to be 95,670. Now that we've got the cost price of these assets, we can work out the depreciation. Okay, so this was calculation, we'll just call it calculation F. Right, now let's go for calculation G. The depreciation, always good to try and split out the different fixed assets that you have. So the depreciation on the, almost said vehicle, on the equipment sold, we're going to calculate that, and then we're going to calculate the depreciation on the other equipment, because now we've got the cost price for both of them. Right, so how do we calculate the depreciation on the equipment sold? It's depreciation on a straight line method. We know it's 10% per annum on the cost price. We know that it was sold on 30 May. So quickly see if you can calculate the depreciation on the equipment sold. Information tells us that the depreciation is 10% per annum on the cost price. Right? So we take the cost price of 55. Depreciation is calculated as the cost price multiplied by the rate for the straight line method. But we can only provide for depreciation for the period that we had this asset. Now the equipment sold was, the financial year is from 1 March 2012 till 28 February 2013. Right? And we sold this equipment on 30 May 2012. So for how many months did we have this asset in the current financial year? 1, 2, 3. Okay, 3 months we use this asset. So we can only depreciate this asset for 3 months. Remember, depreciation is accounting for the use of the asset. So we have to multiply this by 3 over 12. Right, so then we're going to get, it's equal to 50,000 Rand multiplied by 10% multiplied by 3 over 12, and that is going to give us
1,250.
exactly, and that's the depreciation on the equipment sold. Right, now we just need to calculate the depreciation on the other equipment, which we now already know the cost of the other equipment is 95,670. So 95,670, where did we get that? Calculation F, right, times 10%, right, times how many months did we have these assets? We had them for the full year. Okay, because we don't have any other information, we can assume that, so the answer is going to be 9567. Right, then my total depreciation is going to be 1250 plus 9567, and that's going to be 10817. What do we need to do with this depreciation?
Take it to the...
We need to add it back. We're doing the cash flow statement, but we know depreciation in the cash flow statement is a non-cash flow item. So we need to add this back, 10817, and this was calculation G. Okay, happiness. That was probably the most difficult part of this question. Right, let's continue. Interest expense. Let's see if we can find the interest expense somewhere, because we need to add this back because it is disclosed separately here under cash flow from operating activities. It's disclosed there, so we can't include it in cash generated from operations as well. Interest paid is going to be an outflow. Dividends paid is going to be an outflow. tax paid is going to be an outflow. Right. So we can't have it as an outflow in two places. So let's try and find our interest expense. There's information for dividends. We're going to come back to that one right now. And let's see if we can find anything on interest expense. Nothing in the... Oh, here we go. Extract from the notes for the year ending 28 February. Prepaid expense, interest expense of 1.5 and 2,000. Alright, let's just take a note of that. And then lastly, we've got here interest expense in the income statement of 12,500. So which figure are we going to add back here? We're going to add back the 12,500 because this is the figure that was deducted when we came to our net profit before tax. So that's why we're adding back only the interest expense. Right, let's do that. 12,500. Oopsie, that's the wrong place. That's not the interest paid. Right, make sure you don't make that mistake. This is the interest expense that we're adding back because it was already subtracted here in my 171,820. Right, so that's that. Now we can calculate our operating profit before change in working capital, and if you add those figures together, you're going to get 170,137. Now we can calculate our change in working capital, and this is an easy calculation. We're simply going to take last year's figure for trading stock and subtract this year's figure and see what the difference is, and the increase, see if it was an increase or a decrease. So let's have a look at trading stock. Inventories, here we go. Last year it was 588. This year it is 420. So is that an increase or a decrease? Decrease. So we've already filled in that a decrease will be an inflow. So we can simply put your 588, 452 minus 420,145, and that's a decrease. Therefore it's an inflow, 168,307. There's no excuse for getting this wrong. Okay, this is again money for jam. Easy marks. Simply take last year's figures and this year's figure, compare them, see if it was an increase and decrease, calculate the difference, and fill in correctly inflow or outflow. Debtors. Let's have a look at this one. Right, so we dealt with inventories. Trade and other receivables. They've gone from 384 to 462. But now we need to look at the note, and you'll see why. They've given us this note, and they tell us that debtors actually went, this 384 and 462 is actually made up of 3 line items: SARS, prepaid interest expense, and trade debtors. Now these 2 items are going to be taken into account when we calculate the interest, and the tax is going to be taken into account when we calculate these 2 line items. Right? So we can't account for them again when we're calculating this change in working capital. So we only need to isolate, we're only going to take the trade debtors. Does that make sense? If there was accrued incomes that is not separately disclosed on the income statement, or another prepaid expense like insurance or something like that, then we could include the prepaid expense on those specific line items as well, the movement on them. Right? Does it make sense? Okay, but because this is specifically prepaid expense related to interest, we know that's separately disclosed, so we'll take that into account on the interest paid line. The SARS also will take into account on the tax paid line. Right, so we only have 456 minus 382. That's an increase. Right, we can see that's an increase. An increase in an asset is going to be an outflow. So 456, 123 minus 382, 647. and we can tick off these two amounts. Happiness. Right. And that gives us 73,653, and that's an outflow. Right, lastly, our increase or decrease in creditors. Let's see if we can find those. Again here, we can see our trade and other payables. Here's a note. We need to account for this whole movement, but this movement, we're going to account for that separately when we calculate our tax paid. So we're only going to look at this movement. So is this an increase or a decrease?
A decrease.
Decrease. So what's a decrease in creditors? Inflow or an outflow?
Inflow.
A decrease in creditors. That means
Decrease is an inflow.
No, it went from 372 to 368. So it went down. Why would it have gone down?
Because they paid.
Because we paid them. Creditors is people we owe. So when they go down, it means we must have paid them. So a decrease in creditors is an outflow. There we go. 372, 865 minus 368, 350. That's going to be an outflow of 4515. Then we can total these. We're going to get a net inflow of 9139. We add these two figures together. We get our cash generated from operations as 260,276. Great. Where are we going to take this? To the face of the cash flow statement. And let's quickly do that. 260,276. Right. Now we can calculate our interest paid. Now we've done the first line. That was a whole lot of info just to calculate the first line, but that was for 21 marks. So we've scored a lot of marks there. Right, interest paid. Let's call that calculation number H. And let's look at all the information for interest. We know that the interest expense was 12,500. So let's do this. Calculation H, and the easiest here is to draw up your T accounts, and we're trying to find out how much interest did we actually pay. This is the interest expense account. We know that the interest expense amounts to 12,500, right? So when we close off interest expense, we take it to profit and loss, and we know the amount closed off to profit and loss is 12,500. So that goes on the credit side because that's what goes to profit and loss. We know we also had prepaid expenses, so we can tick off that one. Prepaid interest expense of 2,000 Rand at the end of last year and 1,500 at the end of this year. Okay, so if we've prepaid an expense, that means we actually paid too much. So at the end of this year, we had prepaid expense of 1,500, and at the end of last year, we had a prepaid expense of 2,000 Rand. Right. The remaining figure is what we have paid. Okay, so now we can add up this side. This comes to 14,000 Rand. We know that my debits also need to come to 14,000 Rand. And we thus know that the bank amount was 14,000 minus 2,000, 12,000. Okay. Prepaid expense, remember, that's an expense that was paid in advance. It didn't actually relate to this year. That's why we had to reduce our expense with the current year's prepaid expense. Next year, first thing, this prepaid expense is going to be reversed to this account, same as what was done with this prepaid expense. This one came from 2012, this one is 2013. Okay, So interest expense paid then amounts to 12,000 Rand. And let's fill that in. There we go. Right, and that is different from the interest expense at the top here, which is the amount that was included in my net profit before tax. They could be the same if there was no prepaid expense. Okay. If it was accrued expense, again, you would have had to include the accrued expense in your interest expense account. So if there was an accrued expense, you would have your interest expense account. You know your bank account here is the cash flow amount, which is the balancing figure that you're looking for. You take the amount from your income statement, profit and loss. This one comes from the income statement. You put that in here. If there was an accrued expense at the end of the current year, that would increase your interest expense by a certain amount. So that would be for the current year. And any accrued expense from the previous year would be reversed. Oops. Accrued expense would be reversed on that side, and you would then calculate your balancing figure. Okay, so the two, they just swap around. Right, let's add another page here. Right, that's interest paid. Done. Dividends paid. Let's look at our information. We're almost there. So now we can tick off this. We know we saw dividends paid information in information number 2. Dividends paid and declared. We see here that dividends paid during the year amounted to 30,000 Rand, but there was also dividends declared of 7,514 and 14,000 Rand at the end of the previous year. So, how are we going to do this? We know that our dividends paid, this is calculation I. Can you see why you need a separate piece of paper for your calculation? Calculation I, dividends paid is 30,000 Rand. Okay. And the declared dividends, you can think of this as your shareholders for dividends. Okay, so our shareholders for dividends account looks something like this. At the end of the current year, the balance is 7,514. Or let's just say rather, at the beginning of the year, the balance is 14,000 Rand. Which side does the balance go at the beginning of the year? Yes. Beginning of the year, the balance is 14,000 Rand. At the end of the year, the balance is 7,514, and that's going to be my balance carried down. And the difference is going to be my dividends paid. And well, this would be my bank line item, which would be the dividends paid. Right, then during the year, okay, so you can work out the difference there, and you're going to find that the, what is it?
6,486.
Hold on a second. Right. We know the total dividends for the year paid and declared amounted to 37,514. We know that the total dividends for the year was 37,514. That is paid and declared. So that's going to be recorded as ordinary dividends, 37,514. Okay? And we've got our opening balance. We've got all the dividends paid and declared for the year. Right, we've got our closing balance on shareholders for dividends. So we know the difference here is going to be the amount that we paid. So if you work that out, it comes to 44,000 Rand exactly. Okay. And that includes now obviously a portion of, it includes this 30,000 Rand that we paid during the year, and it also includes 14,000 Rand of the previous year's declared dividends that we've paid now. Okay, but it's not important that you know what it includes. It's important that you know how much was paid. It includes, however, this 30,000 Rand paid in the current year, as well as the outstanding balance at the end of the previous year, which makes 100% sense. So we've dealt with all of this information here, so we can tick that off. Right, let's fill in our dividends paid of 44,000 Rand. There we go. We're almost there. We just need to calculate the tax, the investment, and our totals, and then we are done. And this again, we need to show where we got this from, calculation I, otherwise the examiner thinks you just thought of that figure while you were twiddling your thumbs. Correct? Right. Last one, tax paid, calculation number J. Now, easiest way to do our tax paid calculation is to use our T account again. That's the method I prefer. You can use the note as well, but I'm going to show you the T account. You should know the note off by heart as well. Here is my SARS T account. It can be, remember, an asset or a liability. On the credit side, we need to put my income tax, and then my balances goes on either side depending on whether it is an asset or a liability. The amount that I would have paid is going to be on the debit side as a payment, and I need to put in the balances, and then we can work out how much cash we've actually paid for tax. So what do we know? We know that at the end of the current year the balance is 4,200. That's a receivable, so that's an asset. And at the end of the previous year it was a payable, so at the end of the previous year we owed money, 8,500. So where's my opening balance going to be, on the debit side or the credit side?
Credit side.
Credit side, opening balance of
8,500.
yes. Where am I going to get this? We got from the notes. Where am I going to get the income tax expense for the current year? Going to get it from my income statement. So if we go down to the income statement, we see income tax is 51,546. You fill that in there, 51,546. And then we know, so we dealt with that. We know that the income tax balance at the end of the year is 4,200 as an asset. All right. So if it's an asset, that means the balance carried down would be, have a look here. The balance brought down at the beginning of the year for a liability was on the credit side. So the balance carried down for a liability would be on the debit side, right? Now, the balance carried down for an asset is then therefore going to be on the credit side. Right, that's correct. Because after we've balanced everything, the balance brought down would then go here on the debit side. And it would leave us with an asset of 4,200 Rand. Right, so now we can add up all of these figures, and that is actually going to tell us what the bank figure should be, because there's no other debit amounts here. It didn't tell us anything else. So if you add that together, you're going to get 64,246, and this is the only amount, therefore 64,246. Then we can fill that in as our tax paid, 64,246. Right. Now that we've got all the cash generated or cash flows from operating activities, we can add them together to come up with our total. And if you add them together, please remember, very important that you show your brackets for your outflows. Don't forget that. And no brackets for inflows. And the total comes to 140,030. Just want to show you the information. You can see here in our trade and other receivables that we've dealt with all the individual line items, which means we've dealt with these total movements. The same with our trade and other payables. We dealt with those two when we did the change in working capital. We did this one when we did our tax paid calculation. So that means we've dealt with the full movement. Alright. And that means we've actually dealt with these two items because that was the note. And we've also dealt with these two items, trade and other payables. The loan, they've already recorded the financing activities for us, so we've recorded that. The short-term loan, they've already included the decrease there of 20,000 Rand, so no need to include that. Here's my shareholders for dividends. Whoopsie. My shareholders for dividends balance, confirmation of those two amounts there, 7,514 and 14,000 that we had as the opening and closing balances. The retained income movements we get from our net profit before tax movement and our dividends movement, so we've already dealt with that. Ordinary share capital, again, all of that has already been accounted for us. 320, there you can see 1620 minus 1300 is 320, so that's already been accounted for. So all that is left for us is we've already dealt with the fixed assets. All that is left is our fixed deposit. There was an increase in the fixed deposit. An increase in the fixed deposit is an inflow or an outflow. Why would the fixed deposit increase? It would increase if we take money and we put it into the fixed deposit. Okay, so that means it's an inflow. We took money and we put it into the fixed deposit. So what happened to our money? It went out. Right, think always what happened to your money, what happened to your cash? It went out. 565 minus the 450, and that's going to give us an outflow. You get the movement, and then you need to think, did money go out or did it come in for the business? This time it was an outflow, 115,000. That's why we recorded against the increase in investment as opposed to the maturity of an investment, and because it's an outflow we need to record that in brackets. We total that up, these three line items, and we're going to get our cash flow from investing activities of 285,123, 100%. And that is my cash flow statement done. Right, I'm not going to go through the rest of the calculations. Please shout if you have trouble with them. Please send me a note or a question and I could work through them, but work through the memo and see what the memo says. And if you need me to go through them, please send me a message on Canvas. Great, that's the cash flow statement.